Tutorial 3A, Cost Volume Profit Analysis. CVP analysis is a method used to explain the relationship between the changes in the volume and the changes in the total sales revenue, expenses, and net profit. CVP analysis enables management to identify critical output levels, such as the profit maximization point or the break-even point. The break-even point is a point where there is neither a profit nor a loss. CVP is based in the short run of 1 year or less. It is needed to analyze the behavior of costs in relation to the changes in volume, and CVP costs can be classified into two groups: fixed costs and variable costs. Fixed costs remain the same irrespective of the level of output. For example, rent. It's €20,000 the whole way across the year, no matter how much output you make. If you're producing 0 units, your rent is still €20,000 per year. If you're producing 100,000 units, your rent is still €20,000 per year. Variable costs vary directly with the changes in the level of output. For example, raw material costs are €8 per unit. If you have 0 units produced, then you have used 0 raw materials. Therefore, there is no cost. And as you increase production, your costs increase in proportion with output. So if you produce 1 unit, your costs are €8. If you produce 2 units, your variable costs are €16. This causes a diagonal line across the graph. Step fixed costs are costs which are fixed over a certain range of production, but then increase as the capacity increases. A good example for this is rent. You sign a lease for a premises which has the capacity to produce 50,000 units, and you pay €20,000 per year. But if you want to expand your business, you have to produce more output, so you're going to need more premises. As your premises increase, this means you have to pay more rent. This increase in capacity doubles your output capacity to 100,000 units, but your rent has also doubled to €40,000 per year. This causes a step in the graph and produces a stair-like line across the graph. Semi-variable costs are costs which are partly fixed and partly vary with the changes in the level of quantity. For example, telephone costs. You have to pay the fixed line rental of €20 per month. So if you make 0 phone calls in a month, you still have to pay €20. Then you must consider the variable cost element. This is determined by the number of phone calls you make per month. If you make 0 phone calls, you're paying 0 variable costs. If you make 100 phone calls per month, your variable costs are now the €20, which you must add to the fixed cost of €20, meaning the total costs you pay are €40. The formula for a CVP analysis is Y is equal to A plus BX. Y represents total costs, A represents fixed costs, and BX represents variable costs. B is the variable cost per unit multiplied by X, which is the number of units used. Contribution is calculated by sales revenue minus variable costs. Contribution per unit, or CPU, is the sales price per unit minus the variable costs per unit. Contribution indicates revenue remaining after all variable costs have been covered. Variable costs include variable production and variable selling and administration costs. The break-even point is where there is no profit or loss made. It's where the total costs equal the total revenue. It's calculated by the sales minus the variable costs equaling the contribution minus the fixed costs, always equaling 0. To calculate the break-even point in units, you get the total fixed costs and divide it by the contribution per unit. Let's work through an example. In example 1, sales price per unit are €100. variable costs per unit are 40 euros, and fixed costs are 6,000 euro. Let's work out what's the contribution per unit, what's the contribution required to break even, and how many units need to be sold to break even. The contribution per unit is calculated as the sales price per unit minus the variable costs per unit, which in this example is 100 euro minus 40 euro, giving us a CPU of 60 euro. What contribution is required to break even? At break-even point there is neither a profit nor a loss. Therefore, sales minus variable costs must equal fixed costs. In example 1, we know the fixed costs are 6,000 euro. Therefore, to have no profit or loss, we need to have the contribution as 6,000 euro. How many units are needed to be sold to break even? For this, we'll use the formula of the total fixed costs divided by the contribution per unit. The total fixed costs are 6,000 euro divided by the contribution per unit, which we just worked out to be 60 euro. Therefore, we must produce 100 units to break even. To reach a target profit, we need to meet a required amount of sales. To find out this amount of sales, we must use the formula of total fixed costs plus the target profit, all divided by the contribution per unit. Let's look at example 2. What production is required to generate a profit of 30,000 euro? We'll use the formula of fixed costs plus target profit, all divided by contribution per unit. In example 2, the fixed costs are 6,000 euro. We know that in the question it's asking for a target profit of 30,000 euro, and we divide this by the contribution which we worked out earlier of 60 euro, meaning we must produce 600 units to generate a profit of 30,000 euro. The margin of safety is the excess of a company's budgetary or actual units or revenue over its break-even point. It reflects the amount by which sales can drop before reaching the break-even point. It can be calculated in units as the actual units minus the break-even units, or it can be calculated as a percentage of the actual units minus the break-even units, all divided by the actual units. CVP analysis has a number of assumptions. Firstly, it assumes that fixed costs remain fixed regardless of the activity. Whereas we've seen in the step fixed costs that as you expand your premises in the long run, your costs increase. But CVP analysis is based in the short term, and your costs remain fixed and do not change. Secondly, variable costs are the same at all output levels. As we've seen in the example, variable costs are assumed to be 8 euro per unit, regardless of the activity, showing a straight line in the graph. But in reality, as you start to buy in bulk, you may get a discount in the price, which would cause the graph to be a curved line instead of a straight line. The assumptions of CVP do not take this into consideration. CVP assumes that there is no change in the stock level, that everything produced is sold, and it ignores stock altogether for decision making. It assumes the sales price is the same at all output levels, which is not the case in reality. But to have the analysis work for decision making purposes, we have to assume the sales price is unchanging. And lastly, it assumes that there is no uncertainty in the estimation of fixed costs and variable costs, as this would cause doubt and affect the decision making of the firm. This is a break-even chart. It shows the sales line as this line here, and it shows the total cost line as this line here. It allows you to see that wherever the cost line is greater than the sales line, that the firm is making a loss. And then wherever the sales line is greater than the cost line, that the firm is starting to make a profit. Where these two lines cross is called the break-even point. At this point, the sales are equal to the costs, and that there is no profit or loss. This is the break-even point. Let's look at some CVP examples. In tutorial 3B, we'll look at the Leaving Cert Ordinary Level 2010 Question 8. In tutorial 3C, we'll be looking at the Leaving Cert Ordinary Level 2012 Question 8. And in tutorial 3D, we will be looking at the Leaving Cert Higher Level 2011 Question 8.